Have you ever wondered how the global economy actually works? Well, today we're pulling back the curtain on its invisible architecture. We're talking about the rules that govern how companies talk about money. It's the essential blueprint that makes the whole world of finance tick.
So here's the big question, right? If a company in Japan is looking for investment from, say, Germany, how on earth does that German investor trust their numbers? How do they know the profits and losses are being measured in the same way as a local company? And that, right there, is the fundamental problem that global accounting standards were created to solve.
All right, let's start with the absolute basics. Why do we even need these rules in the first place? I mean, it's a fair question. Well, to put it simply, it's about creating a shared language for business so that everyone, no matter where they are, is on the same page. And this is a really big deal. Without that shared framework, trying to compare two businesses is literally like comparing apples and oranges. The whole point is to make sure that anyone reading a financial statement, whether you're a massive investment fund or just a curious individual, has the core info they need to make a solid decision. It completely levels the playing field.
And you know, when you get this right, the benefits are massive. It just makes life easier for everybody. Big multinational companies can combine their books without major headaches. Investors can confidently compare a company in Sydney to one in Toronto. It streamlines the whole shebang from raising money all the way to paying taxes.
But, and this is a big but, it is not that simple. I mean, think about it. Getting over 100 countries to agree on one single set of rules, that's a huge challenge. You've got different legal systems, clashing economic priorities. What's important in a shareholder-first economy might be totally different from one that's more focused on collecting taxes. And then you've got good old national pride. Nobody wants to just throw out their own rules and adopt someone else's.
So how is this whole system of trust actually built? Well, it all starts with a very clear blueprint. Let's take a look at the two foundational pillars that hold up the entire financial reporting framework. Okay, so take a look at this. This chart lays it all out for us. You can see it splits right down the middle into two main branches. On one side, you have the regulatory framework, and on the other, the conceptual framework. Just think of them as the law and the philosophy behind the law.
First up, you've got the regulatory framework. Basically, these are the hard and fast rules. They're the specific laws and regulations a company is legally required to follow. Things like national company law, or the rules for being listed on a stock exchange. In short, this is the what you have to do.
The conceptual framework, though, that's a different beast. It's more like the guiding constitution for accounting. It isn't a rule you can break, but it's a system of core principles that helps the rule makers create standards that are consistent and logical. This is the why we do it this way. It's the bedrock that all the specific rules are built on. Now, this split between the what and the why leads to this really interesting debate in the accounting world. What's the best way to actually write the rules? Should they be a set of broad principles, or more like a super detailed recipe?
And I absolutely love this analogy. On one hand, you have the global standard, IFRS, which takes a principles-based approach. It's like giving a master chef high-level instructions. Create a delicious dish using these quality ingredients. It really relies on professional judgment. On the other hand, you have the traditional US approach, which is more rules-based. It's like a cookbook with exact measurements and steps. It's super precise, which is good, but it can sometimes lead to people trying to find loopholes in the recipe.
And that's why having that strong principles-based conceptual framework, that why, is so important. It's what protects the integrity of the whole system. It makes it much harder for powerful companies or special interest groups to lobby for very specific rules that only benefit them, which helps ensure the standards are fair for everyone.
Okay, so we've got the blueprint, we've got the philosophy behind it, but what actually makes a financial report itself useful and trustworthy? Well, it's time for a little quality inspection.
So the framework thinks about quality in two layers. First, you've got the fundamental characteristics. These are the absolute non-negotiables. If your information doesn't have these, it's pretty much useless. Then, you've got the enhancing characteristics, which are like the nice-to-haves that make good information even better.
So what's the first non-negotiable? Relevance. Put simply, the information has to be capable of actually making a difference to someone's decision. Does it help you predict what might happen in the future? Or does it help you confirm if what you thought in the past was right? If the answer is no, it's not relevant. Next up, and this one is huge, is faithful representation. The numbers can't just be technically correct on paper, they have to reflect what really happened in the real world. The report has to give you a true picture of the company's economic reality, not just cleverly follow the letter of the law in a way that might be misleading.
And to get faithful representation, you really need three key ingredients. First, the information has to be complete. No crucial details can be left out. Second, it must be neutral, meaning it's not spun to paint an overly rosy picture. And finally, it has to be free from material error, which just means no mistakes or omissions that are big enough to change someone's mind.
And then, on top of that solid foundation, you have the 4 enhancing qualities, the icing on the cake. These are things like comparability, so you can actually benchmark a company against its rivals, and timeliness, so you get the info while it's still useful. These qualities are what take good information and make it great.
So, where is all of this headed? For decades now, this entire blueprint we've talked about was laser-focused on one thing: financial performance. But today, the very definition of performance is getting bigger, and the blueprint has to evolve with it.
And here is the next giant leap. In 2021, the very same organization that oversees the global financial rules, the IFRS Foundation, created a new sister board. And its mission? To create a global standard for reporting on sustainability.
So the big idea here is to take all that discipline and rigor we've been talking about and apply it to sustainability information. Investors are now demanding high-quality, comparable data on how companies are managing climate risks and other sustainability issues. And these new standards focus on 4 core areas: the company's governance, its overall strategy, how it manages risk, and the specific metrics and targets it's using.
And this leaves us with a really powerful final question to think about. This blueprint for financial trust was built painstakingly over decades. We are now in a global race to build a similar blueprint for sustainability in a tiny fraction of that time. We figured out how to trust a company's numbers. The challenge for our generation is to figure out how to trust their impact on people and the planet.